The S&P 500, it's coming off its best month of May performance since 1990. Pretty much flat for the year, though, which tells you something. Meanwhile, the narrative on trade, on geopolitics, it seems to change hour to hour, which is good for people in the news business. But what do you make of this moment for investors?
Well, there's always a lot of uncertainty. This year, the uncertainty's been kind of elevated a little bit. But, I've been in the business 50-some years. And, every time uncertainty kind of picks up, people get alarmed. But it's important not to get rushing to make judgments and get out of. In fact, if you look over the last 50 years of my experience, one of the things that makes me sad really is every time the market dips a little bit, people get anxious and get out and then miss out on the upside. Mm-hmm. So anyway,
yeah,
over the long haul, if there are problems, firms address them, get back on track, use a little human ingenuity, and that's what bails us out all the time.
So it sounds like what you're saying, to oversimplify it, is basically just stay invested here.
Well, you always want to pay attention to what's going on, but trying to time short-term moves in the market is kind of a waste of time. Mm-hmm. It is a waste of time. So, but it's always good to review your long-term investment approach, make sure it's still the right approach for you. And that could, for example, something else, other part of your life, may cause you to want to make a change in investments. But just because the market has a little bit of volatility, that's no reason to get out.
Well, the answer for a lot of investors has been index funds. And you talk about your 50-year career. One of the first things you did in your career was be on the team that helped create the first index funds. And it seems like now you've evolved to a point, obviously at Dimensional, where you think you found a better answer than an index fund.
Well, that's right. Basically, indexing is pretty good, but it leaves a lot of money on the table because it's an inflexible investment approach. If you want to track an index, then a lot of your decision making is taken out of your hands. You have to invest a certain way in order to have zero tracking, and that over time is costly.
Mm-hmm. I do wonder, you think about the impact that index funds have had on the entire world of investing and the change that they've brought about. When you look at the next 50 years, for example, what do you think that the next index fund is? Do you think that we'll ever see a technology quite like that disrupts the investment world?
Well, I would never say never, but the kind of technologies people think of are like AI or whatever. Is that going to make stock picking all of a sudden become economically viable again? I don't think so. So what makes indexing work and the so-called passive management is you have enormous trading volume, setting prices, a lot of transparency. Mm-hmm. And so it's very difficult for people to beat the market.
Every time I talk to one of these active managers on TV, and even when I don't talk to people who make their living stock picking, they tell me that it's a great time for active management. Do you think that we ever get beyond that narrative? Do you think it will ever truly be put to bed?
You just need to record it once and keep playing it back, because I hear the same thing. This next year is going to be a stock picker's market. I hear that every year. And I'm waiting for that. It hasn't happened, but no, I think, and there's no reason. You got to have a compelling reason to go out there and try to pick stocks. As Cliff mentioned, it's kind of arrogant to think that you know more than the market. Mm-hmm. The market knows more than you.